UPS beat Q2 2026 consensus. Revenue hit $22.8 billion. Adjusted EPS came in at $1.76. And management actually raised full-year guidance to $91.2 billion in revenue and $7.22 EPS.
Right. But despite that classic beat and raise, I mean, the stock still dropped 7%.
Exactly, a 7% drop right out of the gate.
Yeah.
So if you're looking at your portfolio this morning, you're probably wondering why Wall Street is screaming sell when those headline numbers look so solid.
Yeah, it's definitely a paradox.
It is. And today, we're unpacking that paradox for you. We're going to break down their segment margins, this aggressive network overhaul they're doing, and the specific risks driving this cautious reaction.
So the glaring culprit for that sell-off is sitting right between those adjusted numbers and the GAAP realities.
Right, because the adjusted EPS was a beat.
But GAAP EPS absolutely collapsed down to $0.71.
Wow, yeah. And that's driven by that massive transformation charge, right? Like $891 million after tax.
Precisely. That charge is almost entirely tied to the driver choice program. Basically, it's a union agreement that caps early retirement buyouts at 7,500 drivers.
Right, and they're paying out $150,000 per severance, if I remember correctly.
Yeah, $150K each. So it's this massive upfront cash outlay to structurally change their labor force.
I mean, to me, it's like paying a massive upfront breakup fee to get out of a bad lease. You take the painful hit now to, amputate those expensive roles and save the wider margins.
Yeah, that's exactly what management is arguing.
So I have to push back on the market's reaction here. Like, is Wall Street just being overly punitive? Are they punishing a one-time restructuring cost when it actively lowers long-term headcount?
Well, it's a fair point. I mean,
Yeah.
Wall Street hates messy GAAP numbers because they eat into immediate cash flow. But management is betting that resetting their fixed labor costs is literally the only way to survive.
Right.
The real test, though, is whether the newly lean network can actually generate the operational leverage to justify all that upfront pain.
And if we pivot to the U.S. domestic operating results, you can see that leverage showing up. Operating profit surged 21% to $1.2 billion.
Just huge.
Yeah, and margins hit 8%, which is up 400 basis points from Q1.
And the mechanism behind that margin snapback is what you really need to pay attention to here. Management confirmed that the 18-month Amazon glide down is complete.
So they intentionally shed all those lower-yielding packages.
Exactly, like 2 million of them a day. And by dropping that cheap cargo, they cut $4.5 billion in expenses. They're shutting down inefficient sorting shifts and eliminating entire truck routes.
Wow, just completely gutting the low-margin volume. And they're replacing it with premium volume, right? Like healthcare alone generated over $3 billion this quarter.
Yeah, they traded raw volume for higher yield.
But wait, U.S. package volume actually fell 3.3%?
Mm-hmm.
And in logistics, scale is kind of what absorbs your fixed costs. So can UPS sustainably grow profits strictly through pricing power and premium mix? Or is shrinking total volume a dangerous long-term trap?
That volume question is exactly what has the market spooked today. A strategy of trading volume for yield, well, it looks fantastic for domestic margins right now. But it's super risky for global market share tomorrow. And you see the cracks when you transition over to the international numbers.
Oh, definitely. It proves higher sales don't automatically equal higher profits. I mean, international revenue grew 12.5% to $5 billion. But operating profit actually fell by $59 million.
Yeah, they are facing severe margin compression abroad. A lot of this stems from escalating fuel costs and the expensive reality of network rerouting tied to Middle East geopolitical conflicts.
It just costs significantly more to fly freight around conflict zones.
Exactly. And then you add intense competitive pressure. Retailers are actively diversifying their carriers to avoid the traditional delivery duopoly.
Right, they're spreading volume around to different regional players.
Which forces you to question their ultimate competitive moat. The market is weighing this international pressure against the domestic volume declines.
So they paid a fortune to restructure their labor, and they intentionally shed millions of Amazon packages just to boost today's margins. But leaves you with this final, provocative thought to mull over. As UPS intentionally abandons every day lower margin e-commerce to become a premium, highly automated carrier, do they risk leaving a massive market vacuum?
Huge one, yeah.
And more importantly, is that a vacuum that Amazon Logistics will gladly monopolize? Definitely something to consider. Well, that's all for today's deep dive. Make sure to follow the show for your daily earnings coverage.